All right. So, how you going, everybody? For those who know me, I'm Rick Ewenhoven, owner of a few companies like New Vision, Loan Guides, my tax variation. So we offer a multi-service business, helping people with reducing tax, tax returns, mortgages, all that sort of stuff. And I have a good friend with me. His name's Brian. Been with the Commonwealth Bank for nearly 30 years. Is that right?
That's right. That's right.
And you've just gone out on your own. Well done. Started a company, Latitude Wealth.
Yep.
Yeah. So you've been a financial planner for how many years with this?
15 years.
15, and before that you were like banking, broking.
Yep. A lot.
Yep, a lot. So between the two of us, I hope we should be able to share some insight for you over the next 20, 30 minutes. And we don't want to bog down too long. Everyone's got beer to drink and kids to play with and all that sort of stuff. So firstly, how you going, mate? You're working from home now, and how's it all going?
Yeah, new experience. I've been here since Monday last week. Try and go for a walk with the dogs every now and then, but productivity is probably not the same, but still doing everything by phone and email, so not too bad. Yeah, yourself?
Yeah, same. So I offered the team the opportunity, say Monday last week, I could sort of see where it was all going. So some team members stayed on for a little bit longer, and some of us just decided to bunker down pretty quickly. So it's an interesting world that we're living in. So yeah, so hi Simon, thanks for joining, mate. Sorry, so I haven't seen you in person for a few years. So I've got a fair few of my existing clients, Brian, that I've helped with mortgages and tax over the journey that are in, and we've invited a few people that don't know us as well. So what I wanted to do tonight was just quickly talk about where the banking sector is, what's going on with the banking sector. For those that are potentially worried about their home loans and needing options, we'll do a quick review of that as well, and we'll talk in a general nature about superannuation, what's going on there, and some of the strategies that if people need to try and use to get access to super can take advantage of as well. So yeah, I thought I'd open it up about with the banks, and basically from where I see it, the banks are still open for business. I don't know if the customer or the consumer is open for business, but obviously there's a lot of fear out there. But what I'm trying to say to people is that a bird in the hand is better than two in the bush, and if you've got the capacity to do something with the banks now, and that's what you were thinking of doing now, it's still the right time to do it. What are your thoughts on that?
Yeah, I think so. Like the banks are there to try and drive the economy forward. It's a pretty hard task for them to do, but if you're in a position to do something, you can. And I guess there's opportunities there, and there's also a bit of a bit of forward thinking. So if you do get in tough times, if you can put yourself in a better position now for them, then do it now while you can. So yeah.
I mean, look, I'm not trying to be all alarmist and say that there's not going to be money in the future, but I guess one concern I do have is that, the banks lend to a set criteria of our conduct, and we're in an unknown situation at the moment. So we don't really know how they're going to treat the conduct of pausing our loans or changing the loan structure. And for example, casual workers, if you go from a full-time job to casual, a lot of banks make you wait 6 to 12 months before you can get access to the money. So we don't know if your job position changes through this into that sort of scenario, well then you might come out the other side and not be able to get access to money, whereas you're in a position to work and you can do it to advantage. That's to reduce your interest rate, or to actually have a bit of surplus funds in your account, which we'll talk about in a sec. I think it's definitely worthwhile. My view is where a rate's headed, that I think interest rates are going to be benign for a while because the government's going to be focused on stimulating. What's your view on that?
Yeah, there's very little chance of rates going up anytime soon. They're going to have to try and stimulate this economy, and they don't do it by increasing interest rates. So, there's not much room for it to go down, but every chance is it will go to zero, and then I guess we'll be back into that situation like we were in the GFC, where they'll be issuing bonds to trigger stimulus that way too. So they're going to be fairly cheap rates moving forward.
Yeah, absolutely. I mean, if anyone gets my videos, you'd know that I've done a video called The Interest Rate Truck, where I talk about playing a game of chicken with fixed interest rates and the perils of fixing now, even though the banks are trying to create incentives to fixing now. The perils are that when the fixed rates expire, we could be entering a rising interest rate environment, and therefore we'll have no choice but to take a higher interest rate. Whereas if we stay variable, it allows us to be a bit more nimble and gives us more options how we manoeuvre with our home loan strategy. The other aspect in relation to home loans, credit reports, defaults, the producers of the credit reports. There's been discussion that they are looking at people that put their loans into payment arrangements or put them on postponement. You're getting harassed already, are you?
Dog's having a play fight.
So
tried to do that subtly.
What happens is if we actually miss our payments, well, that leaves a mark on our credit report. But Equifax has said this is an unusual time at this point in time, and so they're going to be a bit more liberal with us and our credit reports, because obviously if our credit reports get affected through this time, that can affect borrowing as well.
Yep.
More a statement than a question. So for those worried about paying their loans, I mean, the thing is, if you're still working, I think the school of thought should be, you've got to keep an eye on the future and what's going to happen with your job and everything else, but it's still work as normal, right? That's how I would look at it.
Yep. Yeah, same. Yep.
So I do think that people have become too tentative with their thought process, but yeah. And so the thing is, if you do have trouble, if you are worried about your repayments, if your job position has decreased, the standard feedback from all the banks is just get on the front foot and call them. I've tried as a mortgage broker to represent some clients, but they've said no, the client has to call themselves. Most of the banks' web pages have got their Corona list now of how they're willing to help, whether it's convert your loan to interest only to reduce your payments, if you need a repayment holiday. One of the banks which I had open just before, which I probably should know, I've got it closed, it might have been ANZ, they were offering a repayment holiday of 6 months, but with a 3-month review. How are you tracking after 3 months? Do you need another 3 months? So the biggest takeaway for me is just speak to the bank if you are concerned, if you're in distress. Yeah, I know some people that are watching are in hospitality, so obviously their position may have changed. They might have been asked to stand down temporarily, so absolutely call the bank. We've spoken about avoiding fixed loans for obvious reasons, but if you feel like the fixed loan is just going to help you with the lowest interest rate possible, well then maybe you do consider it. But again, by all means, if you want to reach out to me one-on-one, I'm happy to talk about that. And I guess the next big question is superannuation, Brian. Like you mentioned the GFC, and a lot of us have gone through this cycle before. What is the cycle and what's going on?
Well, yeah, so we're probably unprecedented right now. Like before this morning, I had a bit of a look at the markets. Just to give you an indication, I guess D-Day was the 20th of Feb. That's when things started going a bit ugly on the share markets. Just so everyone understands, I guess the ASX 200, which is us, has fallen 29.5%, not including today, which is about another 5%. And the Dow, which is the US market's fallen 23%. If we line that up against the GFC, it fell 50% over 17 months. We've been falling for 5 weeks. Totally different beast. So, this is obviously much worse. We're going to go into some pretty hard times, a lot more unemployment. So there's a fair bit of uncertain times, but I guess one thing, not trying to scare too many people, is we came out of the GFC, we came out of the Great Depression, we came out of the '87 crash, we come out of all of them. So the worst thing I guess people can do is panic and change their investment strategy now and put a little bit of faith in whatever they're in to believe that this stuff's going to go up, because it won't go to zero, because most assets invested in a super fund are blue chip stock here, overseas bonds, and for it to go to zero, all the companies that you've invested in have to go to zero as well, which effectively means there's no business. If you look at it in a positive light, your time frame for investment is life, so you've got a long time for correction, and if we're still all working, we're paying money in at a dollar cost average. So, which basically means every fortnight we're buying shares or a portion of a share. So I always use Commonwealth Bank because I work there. But, 5 weeks ago, we were buying Commonwealth Bank shares through our super at nearly $90. We're now buying them at 55. So which one's the one that's going to give us the best return in the next 12 months? It's the one we bought this week. So it's still going down, and it'll probably continue to go down for a bit. But that's the logic we need to look at, and then talk to people, talk to your local financial planner, or talk to Rick. There's a lot of opportunity on the upside. So what we go down by is not necessarily what we have to go up by. So take that into account when you look at things.
I think what you're talking about is very wise with the dollar cost averaging. So if I draw a snake on the screen, that's the business cycle over a 10-year period. And we're buying through that whole dotted period, which means you draw a diagonal line through it that becomes the average. And I think it's a very tricky game for a lot of us that aren't maybe professional day traders to be trying to time the market in italic brackets.
Yep.
But saying that, we know that the market has gone down. So, yeah.
Yeah, I guess if there's the triggers of an improvement in the market are probably pretty obvious for us all. It's not going to improve until there's a vaccine or a cure, or both. So we would be sort of kidding ourselves if we looked at this week and went, oh, the US market's gone up 15% this week. It's going to go back down because there's no profits made in US. So we know that's going to be a downward trend until there's a cure. Or a vaccine. So when that happens, we know there's going to be a change. So we really want to get on the front foot of how do we make some money on the rebound. We don't know when the rebound is going to be, but we know the triggers that'll cause it. So I guess we get ready for that.
The other one that we spoke about before we started was the government announcing that people can get access to $10,000 twice in each financial year coming this and next. From their superannuation if they want to, if they feel like they need to. My view that I've been discussing with clients is I think it's more prudent to potentially look at, if you're really concerned, maybe we do a refinance, get a lower rate, and look at getting a $20,000 buffer if you're in the position to be able to do that. And then you have that buffer there that you don't have to use. It can sit in the offset account. But then if something does happen with your occupation and you don't have the same wage as what you did and you're struggling to make payments and your holiday expires, for example, with the interest rate repayments, you've got that to lean on because the opportunity cost is the returns in super could be greater than the low interest rates that we have at the moment with mortgages.
Oh, look, that's absolutely right. Like even if you've got a low risk super fund now, you're probably looking at a loss over the last 5 weeks or a drop in your value over the last 5 weeks of about 10%. That would be probably the lowest most of us have gone unless you're only in cash. So you just got to look at it and say, well, I'll take 10,000 out. I've already made a 10% loss on it. I'm going to use that to pay off my mortgage, which is at 3%. Or I can just leave it in there, let it recover, and I get my 10% back. So yeah, absolutely. Like if you can leave it in there, do it. And even don't exercise the first one and exercise the second if it's a bit tough. So it can be done. I've got some information here on how to do it if you want me just to go through that quickly. So yeah, the guidelines are, look, initially it's not going to be available until mid-April. And to apply for, you actually have to apply through MyGov site to the ATO portal on your MyGov site. So you don't actually go to your super fund, you go to the MyGov site, you go through the ATO portal to do it. The eligibility, obviously unemployment's one. If you're on any of the payments like job seeker payments, youth allowance, parenting payments, special benefits, all that sort of stuff, you're eligible for it. And you're still eligible for it if you've, as of the 1st of January, you've been made redundant, or your hours of work are dropped by 20%, or your salary's dropped by 20%. So you don't have to be unemployed. So again, casual people out there, if they turn around and knock your hours from 40 down to 20, you could be eligible to grab it. But yeah, don't waste your time in those huge queues on the super lines, because you're going to get to the front line and they're going to say we don't do it. You're going to go through the ATO portal. So yeah, jump on the MyGov site. And I guess if you're not on it, register on it now so you're all ready for it if you have to use it. But that's how you get into it.
Yeah, great. Thank you. It's good to know. So who wants to join those lines if we don't have to? The other one is insurances.
Yep.
So, I guess some people may be thinking, if I get laid off work, can I take income insurance? If I get corona, am I going to qualify for insurance? And geez, I can't, I'm tight for money. I can't really afford the insurances. Maybe I should chop them. What are your views there?
Yeah, okay. So there's a few things there, I guess. No two insurances are the same. So that's the hard bit. So there's not a generic answer to it all. There are some income protection policies out there, like the premium products, that will give you a premium holiday if you lose your job. Will give you a lump sum payment if you lose your job. So if you're in one of them, you've got that protection. If not, well, you still have to pay your premium. If you're in a position where you can't pay your premium, I would look at changing the waiting period of your premium, of your policy, to reduce your premium before cancelling it, because you never know, you might actually hurt yourself to a point that you need to make a claim and you won't have any claim at all there.
So what do you mean by that? Let's say I've got my income insurance and it costs me $250 a month, and I'm insured for 60,000, and it's 30 days.
Yeah, so look, a rough guide, and what I say to clients is the difference between a 30-day wait and a 90-day wait, which is a 3-month wait for your premium, is about 20% in the value of the premium, roughly. Some a little bit more, some a little bit less. So if you work on that, you're going, well, I've dropped it by $50 a month. So you still have it. The danger of it, and you always got to take this into account, is now you've got no income for 3 months if you hurt yourself. So yeah, that's something that you really have to be careful of, but it's something you got the ability to do. There's a couple of things that have, one big thing that's popped out in the media today is about TAL, and TAL are looking at putting exclusions on anyone that suffers any respiratory issues, and including health professionals, regardless of how healthy you are, putting exclusion on the coronavirus. That's only for new applications. So if you've got a policy in place, insurance companies cannot change or add exclusions to your current policy. So if you've got them, don't worry about them. If you're in the process of applying for them, it's an issue. So yeah, don't worry about that so much, but it is out there. And yeah, look, your income protection will pay on coronavirus, but the issue is that if you're a fortunate person to get it, you'll be cured within your 30-day waiting period, so you won't make a claim. You'll be the unfortunate ones that end up in hospital and are there for quite some time. So look, I always say to people, regardless of injury, if you're sick and there's a possibility that you'll go past your 30-day wait, tell your insurer. And then the 30 days has lapsed. If you're still off work, then they're halfway through the application process to start paying you. So yeah, always be on the front foot for that stuff. Just the last thing on insurance. The issue with insurance moving forward is if you're in the process of about to apply for insurance, or you're looking at maybe changing your insurance, we're getting word that it's going to be very difficult to do, purely because one of the obligations for insurance companies to do is to get your medical records and potentially get bloods and stuff like that from people. Obviously, the priority of our health industry now is not insurance applications. So it could take a while to get that stuff through the system. So you're probably, I shouldn't say stuck, so you're probably in the position where you are for a while until things get to a bit of normality in our health services.
So Rob asked as well about that $10,000. Can we take out less than $10,000 if we don't want to take out 10,000?
Yeah, absolutely. Yeah, 10's just the maximum. Yep.
Yeah.
So, but you only get 2 cracks at it. So you get this financial year and next so far.
Yeah, correct.
Yep.
But I guess we just, like we said earlier, you just want to really weigh up the return that you might get with the upswing of the market. I mean, the thing, like you mentioned the GFC, like when you think of the GFC, the government was not very supportive compared to what they're doing through this crisis. You know, the amount of support they're giving for business, for employees, the economy in general. And I mean, what do we have with the GFC? We had Kevin Rudd came out and said, "Oh, we'll give you $750. Go spend on it."
Yeah, that's right. And the government even indicated today, which I think is far more important than the money on the way down, that they've already indicated that they're looking at another stimulus package on the turn of the market to get some of those small businesses that are effectively finished to get back into business. Now, that's really broad at the moment and not specific because it's probably a bit of a way down the track. But the sooner we can get those small businesses open, the sooner the market will turn around. So the government's already looking at that and saying, what do we need to do to get the cafe or the restaurant down the road to open up, you know, day one when we say they can open up. So it looks like they're going to chuck some money at those small business owners to say, here's some cash to get as a bit of a startup. So it'll be interesting. And that's probably a much more important thing than giving money on the way down almost. So, yeah.
Awesome. We've got a good friend of mine, Michael, that's joined us. How are you, Michael?
Yeah, not too bad, thank you.
Thanks for jumping in. So Brian, a friend of mine, runs Latitude Wealth financial planning business, and Michael's a fellow accounting colleague of mine, but also does his own funds management. And I wanted you to come in just quickly, Mike, just to sort of give people an update. We spoke briefly about comparing the market drops compared to the GFC. And I noticed the last 3 days it rebounded, then it's dropped a bit today. What's your take? What's going on in the market?
Look, at the moment, the market is more in a position for a trader's style market. It's not one which any long-term investor should be trying to play in. We're essentially in the midst of a GFC style event where the market has moved beyond what happened during the GFC. We're probably at a downturn of about 35 to 40%. I know that our peak downturn was about 39, and at the moment there just isn't enough good news to turn this around. During the GFC, there were plenty of sugar hits to the market in terms of liquidity applications where the Federal Reserve in the US was providing additional funding to support financial companies to, lubricate the economy. They've come out with a stimulus package, which is about $2 trillion, which is significantly larger than what happened during the GFC. But they've needed to, because, the everyday person is now suffering. Whilst during the GFC, what was happening was mortgage lenders were suffering, and a lot of investors were suffering through the collateralization of debt. This is completely different. This is, every man and their dog is experiencing this. There's no one within the economy which has, escaped what is happening. So it is a little bit greater than anything that we've ever seen. And at the moment, I would certainly not recommend anyone step into the marketplace unless they've got a high enough risk tolerance where they're just going to be day trading or trading for a very short space of time, whether it be, 2-3 days expecting a bounce. Anything outside of that is you're essentially gambling with this market. And if you can't watch it, don't do it.
So it's a good point you're talking about there, because we spoke earlier about dollar cost averaging through the investment cycle, and most of us, myself included, and a lot of the people tuning in, we're just the average mum and dad investor, and trying to time the market is a very risky game at this point in time.
Yes, and trying to time the market in these sort of times is a very dangerous game. One of the lessons which I learned through the GFC was never try catching a falling knife. because you're going to get your hands cut up. But if you do feel that way inclined in terms of wanting to get some exposure into the market at a better price than what it was a month ago, I would recommend stepping your way in. Buy a third of what you would normally. Reassess the situation next week, see what the data says, see what the information coming through says, buy another third. You're not going to miss out on too much of any rally. And, if all of this starts to blow over, buy the last third. You're going to do okay out of it. Your purchase price is going to be looking amazing compared to everyone, but you haven't tried to pick the bottom. And trying to pick the bottom is next to impossible. Even for me, I'm not going to get this right. And I'm getting better information than most people out on the street. And I've got more data sources, more analysts than most people get access to. And, I'm not trying to pick the bottom here. All I'm trying to do is survive and get to the stage where there's at least a little bit of clarity to be able to make an informed decision that we're past the peak of the problem and that we're going to get out of this. So just be very careful, because professional investors are struggling with what's going on at the moment.
But it's not all doom gloom for the people with super. I mean, if you're 55 and under, you've still got plenty of time. You'll recover and you'll get that balance.
Yeah. The world's going to recover. The world continues spinning every day. Even during the depths of the GFC, people were thinking that the stock market was going to halve and it was going to be a complete depression. And, those are the perfect times to buy, when everyone doesn't want to buy. When everyone thinks stocks are the worst thing going around, is the perfect buying opportunity, because things will turn around. The world spins. It will continue spinning whether we're on it or not. And the economy is going to continue. People will continue having children. People will continue striving for a better life. That's never going to stop. So as much as this is a blip in the uptrend, the entire economy is structured for future growth. And sure, we may experience some pain for a year or two, depending, but we will bounce back, and we'll all be looking back at this event in 10 years' time, going like, "Wow, we lived through this."
Is there, if I put my economic hat on, the US, Australia, European government, they're getting their money, they're printing more money, right?
Mm-hmm.
What historically has happened when we print too much money, that creates inflationary effects? Is that something that's going to probably come back to us in the years to come?
Yeah, you'll see a continued misallocation of capital to property and shares. Cheap money goes into assets which will try and achieve a yield, and that will always continue to happen. So at the moment, where the US is now offering negative interest rates on their bonds, the 10-year yield has gone negative. And that means that when you invest in US bonds, you're getting a negative return. So what we will see as a flow on as a consumer is going to be low interest rates and a greater misallocation into riskier assets. So I expect that once this starts to settle down, we'll again start to see property being one of the better asset classes, performing well, stabilizing. But we need to wait for a time when this starts to, when we've got some sort of indication that this is going to be over. And until that time, I'd have concerns. But it could also be a buyer's market, because people with cash will be able to negotiate hard and get really good bargains.
Great. Brian, did you have any questions for Michael from what he's spoken about?
No, I'm good. Yeah, no, makes
Yeah,
Very clear.
it's interesting, Mike. You sort of reiterated what Brian and I were talking about before, where
Oh, cool.
I was sort of just saying I'm not an advocate for fixing mortgages at the moment because I still think it's it's a decreasing market still. So we should all be hanging on and playing a bit of a game of chicken with the economy and waiting before we fix. So you're sort of reiterating that as well, then.
Yeah. I think it's hold tight and just assess the situation. But there will certainly be some golden opportunities for people which have cash to deploy within the property market. Which if you look at it from a long-term perspective, which we really need to, because the GFC was a blip, it bounced back in a vertical way. Just like this is a bit of a blip. Sure, it's going to be painful. We're just going to have to get through it. But when it starts to bounce, if you're on that leg up, you're going to do very well.
Great. Well, everyone's been pretty quiet, boys. Not too many questions. So I didn't actually do any individual accounting speak because everyone listening is really is an employed person, not a self-employed. There hasn't been really any accounting from a tax perspective. Nothing's really come up for employed people at this point in time, has it?
No, at the moment it is very much based on employee looking after employees, which is fantastic. We need to look after people within that sector of the economy, and at the moment it seems Centrelink, get your 10 grand out of super, and try and just get through this situation as well as what you can. Once it starts to fix itself up, that provides further opportunities. So, batten down, assess the situation, and just try and get through it as best as you can, because these are just, people haven't been through a situation like this. And I'm hoping that this is just going to blow over relatively quickly as, I keep looking at the numbers and the statistics, and my viewpoint's a little bit different to others, but I need to be careful in voicing it.
We'll probably find around May budget time that the employees that are looking to see what other packages are going to be for them are usually brought in through tax returns, tax time. So I'd imagine if you guys just keep an eye out for that May budget, I'm sure there'll be some gifts for the tax returns.
They should push that out though, Rick.
Pardon?
They push the budget out though. They have, yeah. So it's not until, is it August now or something like that from memory?
I think there's another announcement coming on Sunday, isn't there, in terms of the third round of the stimulus boost. So we're just going to have to hold tight and see what they come up with.
Yeah.
I think MK Pre might be Michelle Pritterman. She put her hand up. Did you want to type a question, Michelle, in the chat, and I'll ask it? Well, that's interesting. They're pushing the budget out to August. Is that?
Yeah, I think it was a couple of days ago they came out and said they can't actually put a budget together in this environment because it won't make any sense. So they've pushed it out until I think it's August from memory. So yeah,
makes sense. Does that mean maybe they're gonna delay us having to do tax returns until August?
Not that lucky.
No. I was hoping to have maybe an extended break before I have to do tax returns.
Yeah.
Robert Samuel White saying, are all the banks still charging interest payments if you put your loan on hold? Good question. Every bank is going to be treating it differently. So again, it's just going to be the bank that you're with and what their policy is. Have you heard anything, Brian?
I haven't heard of any banks waiving the interest. There are some that said if you need to do refinances and stuff like that, they're waiving the fees, but not the interest at this point.
I find it highly unlikely.
Yeah, I couldn't imagine because they'd actually be going backwards pretty quick doing that.
They'll allow you to delay the interest payments. I guess the thing that I worry about as a business owner or as a personal money manager, of such is we need to be careful of how much we delay because at some stage we still need to pay. and it's going to catch up. So yeah. So Rod, you're asking a question: 50% depreciation for tax. I'm trying to work out what your question would be there.
The government is offering an accelerated depreciation on existing assets at the moment, and anything under 150 is an immediate deduction, but just be aware that it is just a deduction. It's not a rebate. It's not money back in your pocket.
Correct. So whatever your tax bracket is, that's what you're going to save on the dollar spend. So if you're in the 34 cents in the dollar tax bracket, you're saving 34% of the expenditure. Correct. Outside that, if there's no more questions, I'll let these boys go back to their families and a beer or a wine. And I really appreciate you guys coming to share some of the knowledge with me with our clients. And yeah, it's an interesting time, and I'll try and do another one of those people as well.
No worries. Stay safe, everyone.
Thank you.
Thanks, man. Look after yourselves. See ya.